Okay, good morning, good afternoon, and happy 2022. I hope all of you had a safe and joyous holiday season despite the new Omicron variant. It's been an interesting time for all of us. 2021 was an amazing year in the capital markets. Returns clearly exceeded most professional expectations, including our own. And as we keep saying every year, the market isn't going to keep going up 15 to 20%, but 2021 was another great year in the capital markets. It was also a great year for our clients' diversified portfolios. In fact, in my 27 years of doing this was probably the best relative performance that we've ever enjoyed. And we're really excited about going through the 2021 actual client reviews with all of you. Some of you have already done that. From the firm standpoint, because every year we like to do this to start the new year, it was a great year for the firm. Our assets and revenues were up almost 60% year over year, which was very exciting. We welcomed a number of new clients across the country. So since pre-COVID, we've now almost tripled the size of the firm. We've added a number of key new members to the team, which is very exciting. And as we turn the page to 2022, this is the year that we start adding human capital. So as many of you know, Nick joined the firm almost a year and a half ago. He lives in Florida, and we believe Florida represents an incredible market opportunity. So we recently actually posted a new position for an investment officer, someone will be focusing on both client service and business development. And we actually started interviewing candidates the last 2 weeks. Some of them are pretty attractive, and we certainly hope to have a new person in place by the end of the first quarter. We also have identified a very interesting candidate in Southern California, and we plan to add to our Scottsdale headquarter office and hopefully also have somebody focusing on Rocky Mountain, Utah, Colorado, and then 2023, hopefully someplace in Texas. So we have a growth plan. We're well positioned to add a significant amount of clients. And so if any of you feel there's somebody else that would be a good candidate for our firm, either as a team member or as a client, I'd appreciate you reaching out to me and let me know. So with that, I am actually going to turn it over now to Nick and Matt. They're going to go through our 4Q review, our global outlook, and then Nick's going to finish up with kind of our investment strategy research items that we're working on right now. Nick.
Thank you, Kurt. Good afternoon in the East Coast. Good morning, everyone. Not on the East Coast. We're going to keep the agenda similar to prior quarters. So we're going to start with the fourth quarter market review. Then we're going to give you our forward-looking expectations as we look into 2022 and beyond. And then, as Kurt mentioned, we're going to touch on some of our research agenda items for the investment strategy team for 2022. First, we want to look at the current active tilts in the portfolio and some action items. So within fixed income, we maintain a shorter duration tilt. This means our portfolio is less sensitive to interest rate rises, which we've had significant bounce in rates here just in 2022. And then over the course of 2021, we also reduced high yield bonds, which were a great contributor to performance coming out of COVID, but that investment had played itself out, and we've replaced it with public floating rate securities as well as private credit. In equities, we have a modest overweight to value over growth in US large cap and small cap in the US allocation, and a modest overweight to non-US markets. In private markets, we made significant increases in private market portfolios and client accounts in 2021, and we're going to continue to look at investment opportunities here in 2022. And some of what I'm going to touch on at the end of the webcast will be some of those ideas. And then within technology, we continue to push along getting our new global strategic client portal up and running. We're going through some final reconciliation checks, and then we'll be able to kind of release the portal out more widely. Thank you to those who have served as our beta testers on the client portal. It's been very helpful discovering some things we needed to take care of with the portal. So now switching to kind of the markets, touching on 4Q and 2021 in general. As Kurt mentioned, investors enjoyed another incredible year of returns, continuing the strong recovery from the 2020 lows. But we overcome some very challenging macro events here in 2021. We broke those out into kind of 4 major categories that I'll go through now. So in December 2021, the Federal Reserve announced that it will terminate its asset purchase program in early 2022. The asset purchase program was a major catalyst in the market recovery in the spring of 2020, once the initial COVID virus kind of routed markets. In addition, the Federal Reserve is expected to hike the Fed funds rate between 3 and 5 times this year to combat inflation. This is kind of an accelerated policy tightening expectation. And it's really been driven by the fears over the new variants and also inflation hurting companies' profits. And we see, some of the rise in interest rates ahead of the Fed making any moves, kind of whipsawing equities here in 2022, especially growth companies. The news of the policy tightening, as I mentioned, it's made interest rates, specifically the 10-year and the 2-year Treasury yields, much higher here in 2022. And Matt's going to talk about that a little bit further here in the deck. Higher inflation, I'm sure everybody's aware, continues to persist, driven by a lot of consumer demand and also supply chain issues. The employment rate continues to improve, although we may have trouble getting back to the pre-COVID levels of unemployment. And Matt will also talk about this later in the presentation. On the market side, so the investment side, global equities had a great quarter, adding to an already fantastic stock year. As expected, fixed income returns were muted to negative for the quarter and for the year. Since late 2020, as most of you are aware, we've shifted away from core and muni bonds into areas like private credit and real assets, which have added significant excess returns in client accounts. I'd also like to mention a note about how our firm's policy on implementation and our effective use of ETFs. So the use of ETFs have really benefited client accounts. Not a single core ETF that are used in client accounts has issued a capital gain in 2021. And as most of you are aware, this is a stark contrast from the capital gains distributed by many mutual funds. In addition, the income from our preferred real estate investments, Blackstone and Starwood, are mostly untaxed for 2021. The majority of the income is being classified as return on capital. So Blackstone, about 92% of that income is going to be return on capital, and Starwood, 100% of its return on capital. So very tax efficient. As I mentioned, it's been an exceptionally strong year for everything except fixed income. On this slide, we take a little deeper look into the returns of the major asset classes. Core bonds and muni bonds, again, nothing to write home about. Either negative detractors or not adding a lot to portfolio value. As I mentioned earlier, the next category there, private credit, we shifted significant amount of assets from core and muni bonds, depending on our client types in 2021, to fully fund our private credit investments. And you'll see whether it's Varian or Blackstone, both have earned over 11% for 2021, very strong returns relative to core bonds. Global equities have returned over 18% this year. Exceptional year. That makes 4 out of the last 5 years returns for global equities have been over 16%. Just one of the best periods as investors we've ever experienced. In 2021, we shifted assets from public equities into semi-liquid private equities via allocations to AMG Pantheon and Hamilton Lane. This shift was also beneficial as both of those portfolio returns, both of those managers returned over 20% each, in excess of global equities. But the best asset class, saving it for last, has been private real assets. We initially allocated to Blackstone in January of 2021, and then later on in Starwood. Both of these managers have returned over 22% this year, significantly outperforming a mix of bonds and equities. If you recall, we fund those private real assets allocations from 70% private public fixed income and 30% public equities. So when you compare the return of that mix to these asset classes, it was a largest driver of excess return in our client portfolios. We want to look a little bit here at the daily performance and the drawdowns of stocks and bonds in the fourth quarter. Bonds just kind of ticked lower little by little over the quarter as interest rates rose, but I want to focus more on equities. The markets have been whipsawed kind of every quarter, and again, we see it here in 2022 at the start as markets have really had a little bit, they've had trouble here in the first few weeks of the month. The fourth quarter was no different. The market had 2 large and quick drawdowns during the quarter, the largest being 5%. And just a reminder, it's easy to look back and see that, equities are up 7% for the quarter, but we've been dealing with a lot of volatility during the last couple of years. And with the Fed accommodative policies, it's given investors confidence to get, to stay invested and get back into the market. But some of that, is going to unwind here in 2022. I think the important thing to mention here as well is that we're going to continue to use our investment process. We're going to stay disciplined, and depending what the market offers us in returns of forward expected returns, we'll shift the portfolio accordingly.
Great. So this chart shows us the returns of global equities since the beginning of 2020. So in March, we see the drawdown coinciding with the initial COVID-19 lockdowns here. During this time, we were actively rebalancing client accounts and overweighting equities during the declining market levels. So may have not felt great during that time, but this proactive implementation that we did, supported by Fed Reserve intervention through liquidity facilities and other monetary support, added significant value as the markets returned over 100% through the end of the year off the bottom. So the level at the end of the year is almost 45% higher than the pre-COVID peak, with the largest component of that being derived directly from that Fed Reserve intervention and basically pumping excess liquidity into financial markets. So on a forward-looking basis, they've said that that's not going to be something they're willing to do and is less sustainable. So that sort of colors our expectations for the different sub-assets. In addition, one thing to note is that pullbacks associated with the emerging variants of COVID-19, starting with the main, COVID drawdown, they've become shallower and shorter in duration. So really one of the key drivers of returns is not necessarily, these implications with COVID, but more just the level of liquidity in markets due to the Federal Reserve. So on the next slide, we break out the individual components of global equities, seeing that at the beginning of the quarter, all the major equity components were trending upward through the first month of the quarter. Now, in the middle of the quarter, there's a divergence appeared across the regions. Large cap stocks significantly outperformed amid the strong Fed liquidity profile we mentioned before, in addition to a relative overweight to the technology sector and underweight to cyclical sectors that are impacted by slower recoveries from COVID. Now, these cyclical sectors are more greatly affected small cap stocks and international stocks, as cyclical industries represent a much larger portion of those indices versus large cap. In addition, in emerging markets, the Chinese government implemented crackdowns on tech companies in the middle of the quarter, further affecting the performance. So that's why we see emerging markets sitting there down at the bottom, down a little over 1% for the quarter. These headline risks are hard to predict, and they create significant noise for the markets. However, over the long term, what ultimately drives returns are economic fundamentals and earnings. So we'll look a little bit later on onto how that picture looks across these various regions. Now, slide 9 here. So this takes a look at the NASDAQ composite from the beginning of 2021 until yesterday's close, and gives us insights into how unique the performance of these more growth-oriented stocks have been. So the return of the index are generated more and more by a smaller number of constituents. And as a point of reference, over 40% of the companies in the NASDAQ composite currently are down 50% or more from their 52-week high. I've included a couple of examples here, and actually we featured one of them. We featured Peloton last year as an example of a stock that had received a significant tailwind from the lockdowns during the COVID pandemic, causing their price to surge far faster than their earnings capability of the company. Now, since our commentary that mentioned them last year, Peloton has given back about 80% of its value. In fact, there was an article in the Wall Street Journal stating that Peloton is increasing the price of their bikes and treadmills by several $100s to try to offset the large number of canceled memberships they're having. So many of these names that were sort of beneficiaries of work from home and fewer outside activities have come back down to economic reality, giving up much of their gains. So that leaves the returns of the index being carried by a few large constituents of the index. So there's very low breadth and not a significant amount more upside, without increasing levels of upside surprise on those names. So this chart is basically the last 3 years ending 2021 of the 10-year Treasury rate. Relative to history, rates are still low on an absolute basis. And last year, this was a key driver in our decision to reduce allocations to core bonds and implement exposures, as Nick said, to floating rate loans and private credit, which have structural hedges in place against increased interest rates. So we implemented these alongside a shorter duration profile in our investment grade bond accounts. And these moves added significant value to our clients over the course of 2021. Now, on a forward-looking basis, the Federal Reserve is anticipated, as Nick said, to hike between 3 and 5 times. So as that picture became more clear for market participants, yields have increased. In fact, the 10-year Treasury this morning was at 1.86%, So even since the end of the year, it's up 31 basis points, or about 20% of its end of year yield.
Now we're going to shift gears and look kind of going forward what are our expectations for the markets. So this is a familiar slide. I know everyone has seen before. I'm going to spend a couple of minutes on this. We've added some key features to this chart. As a reminder, this slide is an aggregation of our own internal expectations for these asset classes, but we also have our strategic partners that we pull in their information. That way we have a more aggregated look of kind of all the investment house look on this, on the forward-looking returns, and we take away any single bias from any one of those expectations. The chart is separated into three sections: public bonds on the left, public equities in the middle, and private markets to the right. And we've discussed previously how these expected returns represented by these bars are much lower than what investors have experienced over the last 20 years or so. So what we've added to this chart are the blue circles. The blue circles represent the trailing 20-year annualized returns for these asset classes. So we have a good comparison to see what we're getting paid today to invest in these asset classes versus what we've gotten historically. So if you look at public bonds, again, public expected returns going forward are still pretty muted. Investment grade core bonds are expected to return around 2%, whether you're in munis or core bonds, and high yield is now closer to 3%. Those assets are very interest rate sensitive, and with rising interest rates, their returns are impaired. If you look at the blue circles, a lot of these returns are half or less than half of what they've been over the last 20 years. So not an attractive picture looking forward. And again, a reason why we shifted assets into senior loans that will participate should there be higher rates from here. In public equities, again, most of these expected returns are lower than what we've experienced in prior years. US large cap is now about 5% expected return. That's roughly half of what we've experienced on average annually over the last 20 years from US equities. Non-US equities provide a better long-term opportunity, and their expected returns are higher and closer to the long-run averages. We still favor private markets in client portfolios, and they're expected to continue to add value over their public market equivalents. What we added here on this chart are the green circles. The green circles are our GSIS expectation for these asset classes based on how we invest in these asset classes today. So we have a very high quality tilt in our real assets, private credit and private equity portfolio. So usually when you're higher quality, your expected returns are lower. So we just thought it'd be helpful and beneficial to add those expected returns for our semi-liquid private investments. Looking at kind of our main investment model, we looked at this again in the past, so I'll take a little less time than I have previously. This chart compares the attractiveness of US large cap equities relative to the risk-free rate. In this case, we use the 10-year Treasury, and that's represented by the jagged blue line. When the blue line is at the top half of the chart, equities are more attractive. When it's below on the bottom half of the chart, bonds are attractive. But when it's in the middle of the chart, the signal is not really strong, and we're not going to take too much risk one way or the other. This is the type of modeling that directed our firm rebalancing back into equities during the spring of 2020. Matt earlier discussed how significant the return pickup was by buying back into equities in the spring near the bottoms of COVID, as opposed to just sitting in the equities that were held prior to COVID influencing the market returns. Today, the signal sits at 0.53. That's basically in a low information part of the distribution. So today, for the most part, we're going to be right on policy with clients' investment policy statements. So a 70-30 portfolio, 70% equity, 30% bonds will be roughly 70% equity, 30% bonds at this moment. We borrowed this chart from Vanguard. We felt it provided an important breakdown of the US equities outperformance over non-US equities over the 10-year period ending 2020. The US outperformed international by about 8% annualized over this period. And as I described the chart, I'm going to go left to right. So the international return over this 10-year period on a yearly basis was 5.1%. Stronger earnings growth, which I think people would routinely think drove that US equity outperformance, that US companies were so much better than international companies, wasn't really the case. Earnings were stronger in the United States, but it was only 1.5% of that kind of 8% outperformance. The international equities paid a higher dividend, so that kind of helped international equities. But what I really want to focus on is this area and kind of that rectangular circle there. 95% of the outperformance of US over non-US came from currency and valuation change. Now, currency typically is very mean reverting. You know, a country's currency will really appreciate over time, but then normally it kind of it'll weaken relative to other currencies that it outperform, right? So that's typically happened over time. Today, the US dollar is pretty strong relative to non-US currencies, and you'll see that that impact was about 2.1% of that outperformance. But the thing I want to focus on the most is the valuation change. So this 5.4% of the 8%, right, significant portion of that outperformance, that came from the prices of US companies rising in excess of their earnings, right? So prices of US companies supported by the federal accommodative policies ever since kind of the global financial crisis of 2009 and quantitative easing has really helped US companies' prices grow much faster than their earnings. Typically, when we see that in kind of all the academic research that we rely on, when prices rise in excess of earnings significantly, your future returns are going to be low. And that kind of ties back into our capital market assumptions of the US equities having a lower expected return than non-US at about 5%. We see that disconnect here between the valuations and the price appreciation of the markets on this page. So this looks at the cyclically adjusted price to earnings ratio. It's one of our main metrics that we use. And basically the higher the score or the value of the index, the more expensive that index is. So the US at 40, that's basically the second highest it's been ever since the tech bubble. And, you know, we all know what happened there. And non-US, when we look in contrast to non-US and emerging, I mean, both of those are right near their longer term averages, which are those solid lines, and, you know, present a much better valuation expectation for returns going forward. We're basically buying the earnings in those companies much cheaper than we would buy earnings of US companies, since the prices are so high for those companies. Just to dig a little bit deeper into the US valuation, you know, we typically show and talk about the CAPE ratio, but we also look at other metrics when we consider valuations and expensiveness. So we borrow this table here from JP Morgan, which looks at several other metrics. It looks at forward price to earnings ratio. It looks at the Shiller ratio, which we tend to focus in our presentations, but also looks at dividend yield, price to book ratio, and price to cash flow. And if you look at the last column there, all those different metrics are more than one standard deviation, some two standard deviations more expensive than they have been. And that doesn't happen too often when we look at statistics. And again, it makes us, it directs our process to be slightly underweight US equities relative to the rest of the world. But within US equities, there's a big divergence about what's attractive and what's not. Matt mentioned earlier, he went through some NASDAQ information, showed Peloton as an example. But on this slide, we further look at value versus growth within the United States. So we borrow this chart from Vanguard, and what it shows is it compares the price to book ratio of growth companies to value companies. This ratio is used by a lot of fundamental investors, and it compares a company's market cap, which is their shares outstanding times their price, relative to what the book value or what the company's truly worth. The current comparison strongly favors value over growth, even more significantly than the pre-tech bubble and the pre-global financial bubble. I've highlighted those two times in history with those red circles. So we're at a point now where value is significantly cheaper than growth. And in portfolios, we have a modest overweight to value versus growth. And though it's a short period of time, these first 20 days, as we mentioned, you know, growth's been significantly hurt, and value's held up much better here kind of over the last 20 days. I'm going to turn it over to Matt to kind of touch on some of the fixed income and some other metrics.
Thanks, Nick. So this chart shows the yield on the 10-year Treasury with a little bit longer history than we looked at before. we take that yield and then we take out the level of inflation to calculate the real inflation adjusted yield of the 10-year Treasury. So as we can see currently on the right-hand side, the real yield is negative. And that means that the coupons paid on the 10-year Treasury do not provide a return that beats inflation, effectively decreasing your buying power over time. With these record high valuations in fixed income, we've again shifted into credit markets that provide inflation beating yields with unique structural advantages to protect against higher rates. Again, these were extremely beneficial to our clients over 2021 and contributed to our benchmark beating performance for the year. But, as far as, from a historical context, on a forward-looking basis, when real yields are negative, prospective returns are also extremely low. The next slide. So this slide has become a staple of our quarterly commentaries. This is a chart showing credit spreads for high yield and investment grade bonds. So we've previously mentioned on other webcasts that our decision to implement high yield bond allocations in March 2020, when spreads spiked up, added significant value to our clients. Now, after those excess returns were captured, we decided to reduce the high yield allocation and reposition fixed coupon high yield with floating rate loans. Also, in addition to that, we took half of the high yield allocation and allocated towards semi-liquid opportunities with low volatility profile and a yield of over 6%. That's in addition to our strategic private credit exposures. Now, these opportunities are structured with low interest rate risk, and looking forward, private credit will likely provide significant value on top of public market credit allocations, as Nick showed in the expected return slide before. So this was an interesting chart that we included for the first time here. So this is the level of US government debt held by the public. So if you think of this, this is the indebtedness of the US government, and there's a component of that that's essentially the yield that they have to pay to maintain this debt called the debt service. So the current interest expense, which is the debt service, is at $562 billion, with the potential for Fed raising rates on a forward-looking basis 3 to 5 times. As an indication of what that might mean for the government's solvency, a 2% rise in rates will increase the debt service by almost 100%. So it's about a 90% increase. So debt service would go from $562 billion to over $1 trillion per year with a 2% rise in the Fed funds rate. So this for many investors is a signal of the fact that we are overextended, but also that the Fed may be constrained potentially in their ability to raise rates without first retiring other currently held debt. Right, so this was a little bit of a new spin on an old slide. This is unemployment data. The blue line is the actual unemployment rate. We see during the COVID drawdown, unemployment spiked all the way up to 14.7% and has since recovered significantly to the most recent read of 4.2%, just slightly above the pre-COVID levels, which were in the mid threes. One of the things that's new to this chart is that we've included the eligible workers per job opening. So essentially, this pairs the job opening and then the people willing to actually apply to those jobs. So when pre-COVID, you would anticipate that these would be about a 1-to-1 ratio, that things in equilibrium would be for each post, there would be a worker for each job post, right? What's actually happening now is there are fewer workers actually applying for jobs. So we see that, we've sort of overshot here where there are 0.7 eligible workers per job opening. So what that essentially means is there are a bunch of job openings that are being left open because there are fewer people actually seeking those jobs. So this has a couple of implications. One is that this is one of the key components to what drives wage inflation, which is something that we've seen significantly, and that drives a significant amount of the inflation expectations for the Federal Reserve. That's one key component of it. But also it also sort of tells us that the current level of unemployment is different than what it was pre-COVID. So even though the level is almost the same, there's a little bit more to go. The constituency of people that are seeking jobs on a full-time basis or taking partial work, things like that to make ends meet is less and less. So people are not settling as much and are actually holding their cards a little bit closer to their chest. So something that we're monitoring, but as it stands right now, this is inflationary in nature and something that we're closely watching to help inform our understanding of what the Fed might do with this type of data. So I'll turn it back over to Nick to talk a little bit more about some of the specific items we are looking to implement in client portfolios and evaluate over the next year.
Thanks, Matt. So what we're going to highlight here are four of our most important investment projects for 2022 as we continue to kind of build out client portfolios and enhance returns and lower risk. The first one I'm going to discuss is a concept called defined outcomes ETFs. This was recently approved by our Investment Policy Committee. We approved the use of a series of ETFs that will provide investors upside participation up to a certain cap while protecting against initial stock market losses. As markets, especially the US, get overvalued, this investment tool will allow us to stay invested in markets because they buffer the initial negative returns that we may experience in certain markets. So we're looking at adding these to client portfolios here in the first half of 2022. And as we do the fourth quarter reviews, within that, there'll be specific recommendations on each client portfolio about how we like to use these in those portfolios. The second investment project is in private credit. Fixed income securities have significantly benefited from the Fed's asset purchase program ever since kind of COVID hit. But at some point, some of those securities will face price issues, and those prices will become cheap and dislocated to the actual value of the security. So we've been interviewing what are called contingent capital private credit firms. These firms only call client capital when there are dislocated assets that they can purchase and where they believe they can get returns in kind of the mid double digits from these assets. It's important to distinguish that, these are dislocated, kind of stronger, higher quality companies. We're not considering kind of investing in what is also what the riskier part of private credit, which is distressed credit. That opportunity doesn't exist yet, but we think there's an opportunity to be prepared should there be dislocated securities in the fixed income market. The third one, we have interviewed several real estate debt managers. These portfolio loan funds to real estate developers typically as bridge financing until the project can be refinanced with traditional financing. These loans tend to be shorter term, 1 to 3 years, provide attractive yields, and usually a lot of protections for investors. When you think about what we're looking at in private equity in 2021, as you all know, we had 2 very high quality, later stage private equity managers into client accounts. That will always serve as kind of our core allocation. But to enhance the return of private equity allocation, we plan on adding a venture capital manager to the lineup where we can access some of the more well-known, higher quality venture capital firms and or new disruptive technologies like blockchain. We'll keep you updated as we make progress on all these initiatives. The last item I'm going to cover is just kind of a quick high-level overview of the defined outcome ETFs, because again, these will be part of the client fourth quarter reviews over the next kind of several weeks. These innovator ETFs, they have this as part of their marketing materials. I thought it was a good chart to kind of show a hypothetical example of how these security works. So the dotted line is the hypothetical stock market return, right? It can go basically up or down directionally. The solid blue line is the sample investor experience. So on the left of the chart, as the market drops, an investor is buffered from the initial sell-off before participating in losses should the market continue to sell off. In the middle of the chart, as the market rises from a reference point, the investors participate in that price appreciation up to a certain level. After that level, you're capped out and there's no more returns there. The participation, as I mentioned, is capped. The most recent vintage, so these are kind of restruck every month as a series, January, February, March, et cetera. The most recent vintage of these ETFs provides about a 15% initial downside price protection on the equity markets, while with different levels of participation on the upside, but all those upsides are higher than our capital market assumptions for the different equity asset classes. So as I mentioned, there's a lot more to dissect and to discuss here with these portfolios, and we'll do those in the fourth quarter reviews where we'll have more time to discuss the topic. And with that, I'll turn it back over to Kurt. Kurt, are you on mute?
Oh, sorry. Sorry about that. I have my phone on mute. Once again, thanks for the trust and confidence in our organization. We appreciate all of you. And it's going to be fun to have the 2021 reviews to share the great news in the accounts. And I think Nick did a really good job of describing kind of the 4 key initiatives that we're looking at. This is actually somewhat from questions that we've received from all of you, like, what are you guys thinking about next? And that really is our key projects. And once again, if there's anybody that you feel would be a good candidate for a firm, either as a team member or as a client, please reach out to me. We're really excited about the future of this firm and where it's going to be. So once again, have a great day. And if you've not scheduled your quarterly review, we'll be doing that in the next couple of days, and we'll then be in touch with all of you individually to talk about these innovator ETFs. Thanks again for your trust and confidence. Have a great day.